interest rates obviously impact decisions that entrepreneurs are making at the ground level, and they also impact what M&A folks, private equity or strategic acquirers are willing to pay for lawn businesses. Interest rates are really the cost of money and the price of time. If you think about valuation and valuing a lawn care business, if interest rates are 10% versus 2%, that's going to have a big impact on the value an acquirer is willing to pay.
Do you want to make more money? Do you want your money to make you more money? Today, we're talking with a wealth advisor, Nick Bartolo from Essential Partners. He's a friend of the show. He's been on the program before. He's a friend of Jonathan Potoshnik. That's how we got connected. And he is here at the Equip Expo in Louisville, Kentucky, in the John Deere booth. What do you think, Nick?
Oh my gosh, this is the biggest conference I've ever seen, let alone been to. I mean, this place is massive. I actually didn't think I was going to find you, Paul, and make it on time.
Yeah, about 30,000 rednecks here. So I was telling you, it's an event. A lot of beards, a lot of flannel shirt, a lot of hoodies. But what do you think about John Deere giving us this epic studio?
That's what I was about to say. I mean, this is like such a great setup. You have the huge, John Deere probably has the most space in this entire show. They have all their equipment out here. Man, I felt like I was back as a 5-year-old with all these cool toys, around me. So this is a great setup by John Deere. Really cool of them to put this on for you.
Yeah, thank you to John Deere and everything that they're doing here.
And I'll just interrupt you really quick. Thanks for having me here too as well. I appreciate the invitation.
You added a lot of value. Practically speaking, I always wondered how you did a backdoor Roth IRA.
Yeah.
And you made it so simple. You open a traditional IRA, you put the money in, the next day you transfer it into a Roth IRA, and you're good.
So you did it already, right?
I haven't. The good news is I'm making a lot of money, and so I was talking to a tax planner, and we're just trying to figure out every little thing we can do to reduce that tax burden.
Yeah,
which I want to dive into later in this episode, and it's not like I'm making Mr. Producer money, but it's to where every move has to be calculated. So I want to pick your brain about that a little bit later. But what's new in the markets? What's new in the industry? A lot seems to be going on, and especially in election year, right?
Yeah, there is. Yeah, that's a good point about the election year. It's sort of fascinating to me now because I get the sense that across the country, when I talk to small business owners in home services, when I hear market participants pontificate about the market and the economy, everybody seems pretty negative. Do you get that impression from talking to folks?
I do, but
I'm skeptical.
Yeah,
right.
I can see where you get that from.
Yeah, but when you actually look at the data and what the government has been releasing related to the stats, the activity, wage growth, some of these statistics, the economy is actually doing quite well. Okay, and really, since COVID, it's been this paradox where you had all this fiscal stimulus during COVID, and then you had all this monetary stimulus through the Federal Reserve. And then now, after the Federal Reserve hiked rates for a good part of, let's say, 2 years, all the way up to 5.25%, now they've taken rates down. So they recently took rates down 0.5%, which really provides some relief to interest rates. And so I do think that that's going to, help stimulate the economy over the next year or so. The problem with that, however, is that as the economy continues to do quite well, and if the election goes a certain way and animal spirits are revived and small businesses continue to get more and more confident about the future, you could see inflation kick back up. Okay, so that is sort of a balancing risk. I personally think that inflation has potentially bottomed here this month or over the next couple months. And if the economy does well, which I really expect it to do well, you could see inflation come back up, which then, creates more risk. And I don't think anybody's been happy about inflation over the last couple of years. So overall, those are some economic views. I would say, if I were to broaden it out even more, globally, there's a lot of stimulus occurring both on the fiscal and monetary side. So China has announced a lot of stimulus over the past couple weeks, which, as one of the engines of economic growth, that can create a positive impact across the globe as well. So again, look, the economy is one of the most complex multivariate systems in the world, and it's very difficult to predict, but it's always good to pay attention, particularly for business owners when they're making decisions.
Yeah, I forgot to tell you, I was at an event, JP spoke at it yesterday, and a guy came up to me. He's like, I really like those podcasts you did with that money guy. And I was like, Nick Bartolo? He's like, yeah, that was so good, man. So I wanted to tell you got a fan out there.
Yeah.
I said he's actually flying in, and we're going to record another one tomorrow. So he's really looking forward to it. And we need educated about money. How do we take a dollar and turn it into more?
No, I think it's very important. And so when I set up my firm, and the mission of my firm really is to help home service business owners, right? So that's lawn care business owners, pest control, roofing, gutter, across the board, because I don't think anyone's paying attention to this group of people. And this segment of the business community, they're doing well. They're selling their business for a lot of money, but yet there's not a lot of education, just like on a platform such as this. And there's not a lot of folks that are really interested and focused on solving the problems that they have. Okay, so if you're operating a business, how can you reduce your tax bill? If you're going through a business sale, how about reducing the capital gains on that tax bill as well? Because as you know, we have Uncle Sam like continually taking a little money out of our pockets here and there, right? And most
a little,
yeah. 50+% in California and New York, right? And a few other states, New Jersey. And so really it's our mission at my firm to serve home business owners in order to solve some of these problems that they consistently have. And then not to mention the fact that if you go out and you sell your business for $10 million, $20 million, like a lot of lawn folks are doing these days, then what? Right? So you have this business mindset, and you've been on this entrepreneurial journey your entire life, building this business, taking cash flow from that business, and then now all of a sudden you have this pile of money and you need to generate income, and it's a completely foreign world, okay? And so that can lead to a lot of negative outcomes because people make a lot of mistakes, right? Like there's a lot of folks come out of the woodwork at that point, like, oh, hey, Paul, I saw you sold your business for $20 million. Like, you should definitely come invest in my new startup. You should invest in this real estate project I'm doing.
Starting a pizza shop.
Hey, yeah, exactly. Hey, buddy, come flip some houses with me, right? And so I've really seen it. I mean, I even had a case recently where it's like, half of the guy's money after he sold the business was already allocated to 3 different investments from his brother-in-law and his 2 buddies. And I'm like, you might want to slow down here a little bit and like take a breath, get linked up with an expert who can actually guide you over the next several decades in order to invest that money responsibly and generate income then to fund your lifestyle, in a very risk-controlled way.
Can you give us a little bit more detail about your firm, Essential Partners, and how it's different and how it services someone who owns a lawn care business? Do they have to be ready to sell a lawn care business to work with you, or do you have other parts of the storyline where you can work with them?
Yeah.
If they're in the middle of just, like, hey, Nick, I'm running my business. I don't want to sell it for another 5 or so years, but they're making money.
Yeah. I mean, look, like we don't have sort of a one-size-fits-all approach, okay? And so I would never like exclude a certain group of folks from working with us, like in lawn care, for instance. So if you have someone who has, I like to say, substantial revenue that's growing, so, they are making a substantial profit and cash flow from their business, and at some point in the future, whether that's 5 years, whether that's 2 years, whether it's, next month, they're likely to sell that business, okay? Those are the people that we can help the most, right? And if you plan a few years ahead of time, there's actually investment strategies that can also mitigate taxes. And so the way that we're different is that we've thought long and hard about designing our services to help this group of people, okay? And so that has led to a multitude of strategies, both while they're operating and during a transaction, and even after a transaction, to mitigate taxes, but yet generate a good investment return, hopefully market beating, okay? And so one of the core differences, just to like tie it into your question, is that we focus on that group of people, right? Where other folks, they may work with executives that have stock options. They may work with government employees. They may work with people that are approaching retirement. Like we work with home service entrepreneurs, period, okay? And especially those that at some point are going to approach a sale, okay? The other way that we're different is that I own 100% of the firm. Okay, so the only people that I have to please are our client partners. I don't have a boss. I don't have shareholders like some of these big banks have, like these big brokerages. You guys know the names like Goldman Sachs, Morgan Stanley, Merrill Lynch. Like a lot of times, there's a lot of great people working in those firms, but they're constrained by their incentives. So if you're my boss and I work at a big brokerage, like I sort of have to make you happy before I even have to make my client happy.
That's good.
And sometimes that can lead to different decision making than a firm like Essential Partners, where the only person that we need to satisfy and make happy are our client partners, okay? So that's another big difference. And I would just say the last difference is that I spent 20 years helping to manage money for large institutions. So we're talking about pension plans, large endowments, like teachers' pension plans of large state systems, and mutual funds, okay? And so what that entailed was really me going around the world and understanding businesses at a very detailed level, right? And in doing that, you also have to understand how capital flows work around the world, how financial markets work around the world, economies, how they interact with one another. So that's sort of giving me that background to be able to invest money responsibly as long as it matches with the plan of any given particular business owner who has sold their business. As opposed to most folks in wealth management, and this, no disrespect to sales because sales runs the world, especially in entrepreneurship, but they've come up as sales folks instead of investment people. And so there is sort of a big difference there in thinking about the investment philosophy.
Yeah, that's good. What's your thoughts about gold?
Gold's been a really fascinating topic, and because it's up 30% this year, of course, like everybody cares now, right? Like no one cared when gold was sort of languishing and stocks were doing really well. But that actually highlights one of the diversification benefits of gold in that typically, this year's not a great example, but typically when financial assets are peaking, gold is troughing. And when gold is peaking, financial assets are troughing. So it provides this really great diversification benefit to most people's largest holding, which is U.S. stocks, okay? So let me give you an example. In the 1970s, I'll take you back to the 70s, the decade where I was born, stocks did really poorly that decade. And that decade was really marked by stagflation. So the economy wasn't growing, and this is part of that core four that we talked about last time. So the economy wasn't growing as fast as people thought, but inflation was high in the 1970s. That's stagflation. So during that decade, stocks increased from point to point about 6%, okay? But inflation was 7%. So you're actually losing money in stocks in real terms. But in the 1970s, and this is after President Nixon ended convertibility of the US dollar to gold, gold for the entire decade increased 31% compounded. So that means $100 of gold in 1970 turned into around, I think it's $1,700. Okay, and stocks, 100 in stocks turned into 180. So you can see like that tremendous difference between gold and stocks in the 1970s. So stocks do poorly, gold did really well. From 2000 to 2010, stocks were negative for that entire decade, okay? Most people don't remember that or realize that.
I remember that.
Yeah, right? The OG tech bubble, I
got my first stock, Nick, in, it was, I think, 1998. I got MSFT, Microsoft, and DIS, Disney. So I'd come home from school every day. We didn't have the internet, so I would call up, and then it would tell you if it went up or down. And I would do that every single day. And then my dad was kind of like, just relax a little bit. But I was obsessed. But I remember when everything tanked.
Yep.
And so what was it called? The .com bubble?
The .com, the internet bubble. That's really when I got sucked into wanting to do this professionally. Yeah.
But anyway, you said you probably forget, but I don't.
You remember.
I remember those days.
You remember, Microsoft did nothing for 13, 14 years, really. And so from 2000 to 2010, when U.S. stocks were negative, gold actually was up 14% a year for that decade, okay? So that's, again, shows the diversification benefits. So I tend to not make market calls per se because I do have the humility to understand that these are complex decisions, the future is uncertain, but gold has provided really valuable diversification benefits. And since the year 2000, gold's up 9.5 times. And the U.S. stock market, the S&P 500, is up 6.5. So since the last 24 years, it's actually drastically outperformed stocks.
Now, what's your philosophy, Nick? I was having breakfast with a friend, and he invests in some single stocks.
Okay.
We're talking about mutual funds, the S&P 500, an index fund. What's the Nick Bartolo philosophy if somebody has, their investments? Should it be in a S&P 500? Should it be in mutual funds? Should it be in individual stocks, a mixture, gold?
And was this person doing the investing themselves?
Yes.
Yeah. So the way I typically think about it is that individual stocks can be incredibly exciting to own, right? And oftentimes they're very alluring, but can also then lead to really bad mistakes.
Enron?
Right. I mean, all types of things, right? Like, it's very easy for humans to get sucked into the emotion of greed, and then on the other side, fear, right? So wanting to buy more of NVIDIA, a stock that's like been, let's call it to the moon, as they say, to then go buy more at the potential top. And then if something were to do poorly, you want to sell everything at the bottom, okay? So you do that over and over, you can end up losing all of your money, okay? And so the way I typically think about it is that I design portfolios of really low-cost index funds or ETFs around the world, and then I also augment that with specialized private funds or other, idiosyncratic investments, okay? When there are folks and clients that want to own individual stocks, what I'll typically do is I'll say, let's have a conversation about that. Let's aggregate a certain amount of your money to individual stocks. Go nuts. Right? Like, is that 5%? Is it 10%? Is it 1%? It just depends on the person.
Is that only if they say we want to do that? You don't recommend that?
I don't do it.
Okay, so it's just if they're itching to do it, you're like, let's do 1%.
Yeah,
5%.
like let's do 5%, and we'll put that in a separate account. And if you want to manage that and you want to buy stocks that you're passionate about, like maybe, John Deere, you use their equipment, you think it's a great company. Okay, do it.
It is.
Right?
Yeah.
Exactly. And so and oftentimes when you have that firsthand knowledge of a product, like John Deere, for instance, then it does make sense where you're like, you know what, I really believe in this, right? Or somebody, they go to Starbucks every day and they're like, you know what, I'm going to invest in this company, right?
Yeah.
Whatever the case may be. Oftentimes I find that works best rather than trying to, be a person who's a lawn business owner and then who's off buying technology stocks that you really don't have any core competency or understanding of the business.
Okay, so you kind of answered that on the single stocks. In regards to a mutual fund, it's like, which one do I pick? Whereas you mentioned, I think, is IVV and VOO. Those are simple. It's like, okay, I'll just put it in those 500 companies. What mutual fund versus the S&P 500? What's the pros and cons in Nick's take?
Yeah, so my take on mutual funds versus ETFs really is that most actively managed mutual funds don't outperform the index funds, okay? So you have higher costs associated with owning mutual funds. Those may be 0.5% to 1%, let's say. And for IVV, you're paying like 0.02%. So the cost is significantly lower. And then the mutual fund manager, the portfolio manager, has to actually do better than the index, which history has proven that to be very difficult, especially over a long period of time. So they might be able to do it for a few years here, a few years there, but doing that over 10, 15, 20 years has proven to be very difficult for portfolio managers. There's also another adverse consequence related to taxes and mutual funds. So an ETF, you buy it and you don't pay any tax on it until you actually sell it. And you could actually let that money compound for 10, 20, 30 years. And one of the most powerful things, I take this from Warren Buffett, is like one of the only advantages that the government gives you as it relates to investing as taxes is that deferral of taxes, okay? So you can let the money compound over long periods of time and not pay taxes, as opposed to you sell it every year, you pay a capital gain, your money goes down, you have to build back up, okay? So to bring it back to your question on mutual funds actually make you pay capital gains taxes every year or most years because they distribute capital gains profits at the end of the year, which then, even though you didn't sell, you get a bill and you have to pay capital gains taxes on, okay? So that can be a substantial drag when thinking about taxes on mutual funds versus ETFs, okay? On occasion, you might be able to find a manager that can outperform the market for a number of years, but it's not necessarily a bet that I would recommend folks taking. and not something that we tend to do. If we invest in actively managed funds, it'll be much more specialized. Okay, let me give you an example. So one fund that my client partners have owned over the last number of years is a Japanese shareholder activist fund. Okay, and I invested directly in Japan for well over a decade, and I actually guest lecture about this topic to students at my alma mater, which is USC, both the graduate business school students as well as the undergrads. And what's interesting about this opportunity in Japan is that you have a lot of companies that are smaller companies, so anywhere from, let's say, 100 million to 1 billion in US market cap, so the value of the companies. But these companies might have let's say you have a $1 billion company. They might have $500 million of cash on their balance sheet.
Wow.
Okay, they're just hoarding this cash out of safety, out of some historical financing issues in Japan, out of just like conservatism. And so what this fund does is you go in and you take a large ownership position in these businesses and you get them to change their cash policy. So they pay larger dividends, they go out and buy stock, and this causes the share price to increase substantially because now that cash is actually being deployed for the benefit of shareholders. So to me, that's like a very specialized strategy, and the performance of that strategy is linked to the actual actions of the manager, not necessarily to just their prediction about where that stock might go. Okay, so that's proven to be, a really outstanding performer over the last several years, and there's still, I think, more to come in that strategy.
To just a basic beginner, though, S&P 500 is a good way to get started?
I think so. I mean, with one hesitation and one word of caution, okay? So the S&P 500 has been far and away the best performing index over the last 15 years since the global financial crisis. Today, if someone were to go out, again, call me if you want actual advice, don't necessarily. This is my disclaimer here.
Give the disclaimer.
This is my disclaimer. This is not financial advice. I hate to do that, but I have to.
This is entertainment purposes
Yeah,
only.
This is entertainment purposes only. If my compliance person's listening, entertainment only. But
we have the John Deere compliance people listening, so we got to be on top of this.
Those guys are serious.
They are.
And so I actually would prefer a global stock index. So an index that not only takes into consideration, or not only owning the S&P 500, but the whole world, okay? And then beyond that, I think VT is one. It's the Vanguard Global Stock Market Index. And then I think beyond that, you actually have a very wide disparity between large company valuation and mid-size or small company valuation. So the large companies, all of the names that we know, Google, Microsoft, Amazon, Meta, NVIDIA, these companies' valuation, so their, let's call it the price to earnings multiple, or their cash flow multiple, or EBITDA multiple, which has obviously become very familiar with lawn business owners who are selling, their valuation is historically wide versus small and mid-sized businesses. So in addition to a global stock market index, it would likely make sense to have a small cap index and maybe a mid cap index as well to be able to take advantage of some of these valuation disparities, which tend to correct over long periods of time. Valuation is a very poor predictor of short-term stock price performance, but on a longer-term basis, the predictive characteristics of valuation is quite good. So as opposed to just doing S&P 500, I would do something broader, global, and then also potentially small and mid-cap indices as well on a global basis there too.
Nick, we have people of all age ranges listening to our program, but there is a lot of these 18 to 24-year-olds listening, and you mentioned the word compound interest earlier. I wish when I was an 18-year-old, somebody would have drilled it into me how wonderful this is. Can you give us a little explanation of why compound interest can make you very wealthy if you take advantage of it?
Good question. So Albert Einstein, I think most people are familiar with that gentleman, he called compound interest the eighth wonder of the world, okay? And the reason he did is because what compound interest is ultimately, if you invest $100, okay, and then that goes up 10%, now you have $110, okay? So the next year, if it goes up 10% again, you're not only making money on your initial $100, but you're also making 10% on the $10 that you already earned, Okay, so then it's essentially you make $11 the next year. So now you're up to 121. So that compounding nature of earning that interest is incredibly powerful over long periods of time. So you can imagine, and it's also I would remark that brains don't work that way, right? Our brains are like very linear in how we think, like it's a straight line like this. But compound interest causes this exponential growth of your money because you continually make money off your money, and as you've made more money over a long period of time, that interest you're earning off the money you made explodes. Okay, and so that is what I would say would be like the most general explanation of compound interest. But it's incredibly powerful over long periods of time. I mean, we talked about this example the last time we chatted about, Roth IRA and putting $14,000 in a Roth IRA. I believe we used 40 years over that time and 7 or 8% returns. So just doing that $14,000 per year between you and your spouse over 40 years and earning 7 or 8% turns into $1 million, right? So I think that's a great illustration of the power of compound interest.
Yeah, that's good. In regards to interest rates, we had some news a little while back about a cut there. Can you explain to us interest rates and then how that affects everything else?
Yeah. So the Federal Reserve, after increasing interest rates for a few years, recently cut interest rates by 0.5%. And so what was fascinating about it, though, is that everybody cheered, interest rates are now going back down, but the market, the financial markets, including interest rates, are all based on expectations. So paradoxically, since the Federal Reserve cut this short-term interest rates, the Fed funds rate, longer-term interest rates have actually increased. So the 10-year bond has gone from 3.65% or so to 4.2% since the Fed cut interest rates. And what does the 10-year bond impact? It impacts mortgage rates. So since the Fed cut, mortgage rates are actually up, right? And so financing rates in general haven't seen as much of a benefit from that cut. And the reason that is because markets were anticipating that cut, right? So interest rates had already come down substantially before the Federal Reserve cut rates, but now they've kind of trended back up a bit, okay? The other interesting thing about interest rates, and again, this impacts everybody because if you want to go out and finance some of this nice John Deere equipment, right, you're likely going to take a loan to do it unless you're, very well pocketed.
They do have in-house financing here at John Deere.
Yeah. I'd be interested to talk to those folks and see what those rates have done recently, or over the past year. Because interest rates have come down a lot over the past year. But yeah, so, interest rates obviously impact decisions that entrepreneurs are making at the ground level, and they also impact what M&A folks, private equity or strategic acquirers are willing to pay for lawn businesses, okay? So interest rates are really the cost of money, okay, and the price of time. And so if you think about valuation and valuing a lawn care business, if interest rates are 10% versus 2%, that's going to have a big impact on the value an acquirer is willing to pay. So last year in December, when the Federal Reserve indicated that over the next year to 18 months, interest rates are likely going to be coming down, to me, that was the green light for private equity of, okay, we don't have to worry anymore about further interest rate increases, and we can go out and be aggressive in terms of buying new lawn businesses, for instance, because we know what the interest rate environment is likely to be, okay? Because what happens is that when a private equity firm goes out and acquires a lawn business, here's what they do. They say, let's say we want to buy this business for $100 million. We're going to take $60 million approximately from our investors who invested with us to earn a return, okay? And then the other $40 million, we're going to go finance it, and we're going to borrow in order to do that. And so then they'll take $40 million from borrowed sources. And 4 years ago, they were borrowing at 6.5%. And a year ago, they were borrowing at 11.5%. So there's a substantial increase. You could see how that might impact what they're willing to pay for a lawn business. But now, as interest rates are coming down, it can give them more confidence and clarity about their financing costs, which can then, lead to an uptick in acquisition activity. And I would just add on that point that these loans that private equity is taking in order to finance lawn acquisitions, we actually invest in those. So There's funds that are really great actually for lawn business owners that are selling to replace their income. You can actually invest in these loan funds. So these companies are multi-$100 billion asset managers. They collect money from big endowments, pensions, and guys like me. And we invest money with them. And then what they do is they go out and they lend that money to finance private equity deals. And right now, those types of loans are generating a 10% distribution yield, okay? Which, look, over the past 15 years when interest rates were sort of pinned to zero, thinking about getting a 10% distribution yield on a loan that sits at the top of the capital structure. And what that means is that they are the first ones that get paid back. It's like a bank, essentially, right? And so being able to invest in those loans at 10% after you sell your lawn care business, I think is really attractive. And you're not really experiencing the vicissitudes and volatility of the stock market.
What other investment opportunities do you see out there for somebody who's not ready to sell yet and get that big lump sum? They're just building their business, they're profitable, they're making good money, but they want to be smart with that money that they're making. What's the best investment opportunities at that stage of a lawn care business owner?
You know, at the end of the day, stocks, equities, they've had the best long-term return, okay? And there's various forms of that. There's public stocks, there's private equity, right? But let's just talk about things that are available to the person you're talking about. Going back to those index ETFs, that's really probably the best thing that they can be doing with their money over a long period of time. So in thinking about how can I take advantage of this compound interest, I'm early in my career, I'm going to be socking away however many dollars a month, $100 a month, $500 a month, whatever the case may be. Really the most effective way to do that and tax efficient way to do that is to just invest in a global stock market ETF. That's what I would advise them. I have my framework that does create diversification in case stocks don't do well for a long period of time, which over various decades, 3 out of the last 9, stocks have actually underperformed cash. So there's other diversifying assets like gold we talked about, commodities, which can also be pretty effective, especially when you think there's a lot of geopolitical conflict, unfortunately, in the world. That tends to be inflationary. That tends to lead to oil prices going up. So having some exposure to commodities could be wise. And also just like making sure that you do have your short-term needs taken care of in terms of your cash needs and having that buffer if something were to go wrong, to have that in, short-term instruments like money market or T-bills earning, about 4.75% right now.
And I think there's a big portion of those who are listening, Nick, that one day want to sell their business. And so you've worked with guys in the pest world that have actually had the sale for 10 million, 20 million beyond. What's your advice to somebody as they plan ahead that one day I am going to sell, or maybe they are even getting closer to that sale? What's your best advice to make the most of that and not have to pay more taxes than they need to, or to, if they could have sold their business for 20 million, but they only sold it for 12 million because they didn't think about this? What's your advice to a lawn care business owner who might sell their business one day?
There's a number of strategies, right? So I have basically a menu.
And we'll put Nick's information in the show notes.
Yeah, I say that tongue in cheek, but it's true because some of these strategies are proprietary, right? They're all well within the tax code, like not even close to the line. I only deal with blue chip companies and blue chip investment organizations that I partner with. But there's really a menu that I have depending on someone's situation, okay? So, you may have somebody that's very charitably inclined. They've always given, 10% of their money to their church, right? They maybe have other organizations they're passionate about. There's strategies that can take advantage of that where you can actually donate a portion of your private business into a donor advised fund before the sale, okay? That creates 2 tax benefits. The first one is that portion that you donated into this donor advised fund, you don't pay capital gains tax on it because you've already donated it. However, you get the full deduction against your taxes, so against your capital gain on that donation. So you get 2 tax benefits right there. And then, since you're charitably inclined, you're going to make other contributions throughout your life. So that donor advised fund, you don't actually have to donate it on the day you contribute it. We can invest it, it can grow, and then you can make periodic contributions to the charity of your choice over time, not just in 1 year. And it's also a really low-cost solution relative to a foundation or some other more complicated structure. So that's one item of something that's on the tax menu, but there's others as well, right? So it's really kind of understanding someone's individual situation in order to come up with the strategy that's right for them, okay? There have been, though, new strategies created over the last number of years that if you have money to invest, right? So $1 million, $3 million, like approaching the sale a few years in advance. There are strategies related to investments that we can implement that can substantially decrease your tax burden. So again, it's a case-by-case basis. It's hard to really give a lot of estimates because every situation's different, but we've seen circumstances where folks can reduce their tax burden by up to 20%.
Wow.
Right? So let's say someone has a $5 million tax bill, getting that down to $4 million, like that's a substantial difference, right?
Yeah.
So that's, and again, like that's something that we're on a mission to do because, I'm sorry, the government's very inefficient. They waste a lot of money, but yet they collect a lot of taxes.
Yeah. Can you school us on inflation, kind of explain what it is and how it impacts a lawn care business owner and the economy overall?
Look, I think everybody has experienced inflation really for the first time in a substantial way, I would say, in our lifetimes, like you and I, right? I mean, we've lived in this disinflationary world, which has been beneficial for a lot of consumers, but it's also had negative effects for some people. So if you think about since 1981, the Fed funds rate was at 21%. Like most people might not even believe that, right? But the Fed funds rate went from 21 to 0 over the course of 40 years. And the reason it was able to do that is because you had a lot of disinflationary forces. One of those was globalization. So as the U.S. moved their productive capacity outside of the U.S., their manufacturing capacity outside of the U.S. to places like China, that caused prices to go down, so a disinflationary force. You also had taxes that were coming down on a structural basis from when Reagan came into office, taxes came down substantially. I know we all complain that taxes are high, and they are, but they used to be a lot higher, okay? And so that also is disinflationary because if you think about the reverse, if taxes are going up for companies, they have to raise prices in order to generate the same amount of cash flow on a go-forward basis. Another factor was the regulatory environment. So again, since Ronald Reagan came in, regulations tended to go down, but now I think they're going in the other direction where you have antitrust lawsuits, you have more regulation being put on by the government, and that tends to be inflationary. And then geopolitical conflict can also lead to inflation. And we really had a peaceful time from the early 1980s up until the last few years. So what I'm trying to outline here, Paul, is that a lot of the forces that were disinflationary over 40 years have actually now turned in the other direction. And I think we're going to have structurally higher inflation over the next decade. Okay? And that doesn't mean that it's going to be 9%. It doesn't mean that it's going to stay at 6%. Inflation is a cyclical phenomenon as the economy ebbs and flows. But on a longer term basis, like what we experienced over the past 40 years and even over the past 15 years since the crisis, I think that environment is behind us. And thinking of sort of 3% to 4% inflationary environment, I think is much more likely.
Someone who owns a lawn care business, can you speak to them of their prices and how much they should be considering raising their prices in a congruence? Or I'm not sure what your opinion is,
Sure.
but I'm just thinking. We speak on the podcast, and we have for years, raise your prices every year, raise your prices every year. But now more than ever, it's like if you don't raise your prices, if you charge what you did last year, you're really in trouble.
Yeah, no, you're absolutely right. So over the past 15 years in this low inflationary environment, yeah, you should have still been raising your price, but it didn't hurt you as bad, right? Because all of your costs were a bit muted. Now, with this higher inflationary environment, as you point out, it's critically important to raise your prices consistently. And the way I would think about it is that 3% is table stakes. Like you should be taking up your pricing well above or at least 3% per year, just based on at least my long-term view of inflation, which who knows, could be conservative. So there's this concept. There was this famous economist in the 1930s. I'm going to take you back to the 30s now. His name was Irving Fisher, okay? And he came up with this concept called the money illusion. And really what the money illusion is that it really invites people to think about their return, their revenue growth, and their profitability in real terms as opposed to nominal terms, okay? So nominal terms would be, hey, my business is growing 5%. Like, that's great. I'm happy with that. But like inflation's up 7%. So in real terms, your business is actually declining by 2%. Oh, let me tell you, my profits are up. My profits are up 7. It's like, well, inflation was 9. So like you're making way less money, not way less, but you are making less money. And so thinking about your business in real terms is much more effective than thinking about it in nominal terms, okay? And this also applies to your employees, right? So, wage growth most recently, and this is something to think about in terms of that pricing equation, the most recent wage growth data is over 4% increase year over year, okay? So if you're not taking your pricing up 4% or higher, then wages are compressing your margins.
Wow.
Right? And so that's something that has to be considered as a lawn care business owner. And the other, I guess, the benefit of those higher wages are really that your customers, if we think of that wage growth number on an economy as a whole, your customers actually have more money in their pocket as well, so they can pay it.
Yeah.
Right? So their wages are going up 4% as well. So taking up your prices 4% or more.
If you owned a lawn care business, Nick, typically in the spring is when the big boys raise their prices. But what would be your strategy? You just own Nick's Lawn Care. Are you going to raise your price every spring by 3%, 4%, 5%? It depends. But you would say you have to raise them every single spring?
I would. Yeah. And you bring up a good point, Paul, because those big boys, if you will, and I've heard you talk about this, I've heard Jonathan talk about it. It's like those big companies, I would say they have a much more acute focus on taking up price, okay? And as a smaller operator, what that allows you to do is to come under that umbrella or along with that pricing umbrella, okay? And so they kind of give you that cover in order to take up your prices so you're still in line with the market.
Yeah, that's really, really good. I had a question about, is there anything else you wanted to say on that?
No, look, that's what's a private equity firm going to do when they acquire your business? First thing, take up prices, right? So take a page out of the private equity playbook when it comes to prices and just go ahead and do it. Because if you take up prices 10% and you lose 5% of your customers, guess what? You're still better off.
Yeah. JP said that on the show. He's like, as soon as they sold Service Autopilot, the very first thing they did was raise the prices. He's like, why didn't we raise the prices while I was running it?
Exactly.
The very first move that new ownership made was raise prices.
We all have this baggage, right? As a business owner and entrepreneur myself, like you're always worried about your prices and making sure you're offering a lot of value for the price that you're charging people. But I think it is just that. It's baggage, and that folks need to consistently take up their prices.
Back to the Roth IRA, $7,000 investment a year for someone who owns a lawn care business. And if they have a spouse, I'm single, but if they have a spouse, they can put in an extra, like, Pookie, his wife can put in another Pookie always makes his way into the show. But his wife can put in $7,000, so they can put in $14,000. So once you put that $14,000 in, though, you've hit a limit.
That's right.
You can only put that much in per year. So let's say,
and that limit goes up every year.
Right. But even if it's $7,500 and then $8,000, let's say you want to invest more than that. How do you go about doing that? Because you can't put it into your Roth IRA, even with the backdoor Roth. You've hit the ceiling.
True.
What's the next move?
So really the next move is...
Pardon me, Nick. That should be the first move, right?
That should be the first move. A Roth IRA, I think, should be the first move for everybody, right? Just because, again, to describe it to folks, a Roth IRA, you're putting in money that you've already paid tax on, okay? But then it grows tax-free forever, and when you withdraw it, you don't have to pay tax again, okay? if you have a 401k, right, you could do a 401k as well. Like, so if you're a business owner, you offer a 401k, like clearly you should be doing that as well. And the contribution limit on that is $23,000, okay? But let's say you don't have a 401k. Outside of a Roth IRA, really the best thing to do is just a taxable account, right? And a taxable account, it's not terrible, right? It's not as good as a Roth. You've paid tax on the dollars, you put the money in the taxable account, you buy a global stock market ETF, and you just let it compound, right? When the market goes down 30%, you don't get scared and sell it, because that's the worst sin that any investor can commit. Buying at the top can be cured. Selling at the bottom, now you're out and you're not allowing the money to recover, right? But what's good about a taxable account is that you can buy a global ETF, let it compound for 20, 30, 40 years, and you're going to see the benefits of that compound interest. And then when you sell, you'll pay capital gains, which is the lowest tax rate, right? So the highest capital gains tax rate, as opposed to being 37% for ordinary income, it's 23.8%.
Now, you called it a taxable account. Is that also known as a brokerage account?
Yeah, just a regular brokerage account that's taxable, right?
Okay.
So I just think about that designation of what the tax treatment is for any given account. And so it's just a regular brokerage account, Charles Schwab, Fidelity, Vanguard, whatever you choose. Those are all great low-cost options. And then just let compounding do its work. I mean, really, what you're doing is you're buying an ownership interest in the most productive, well-run businesses in the world, and you're doing that on a diversified basis. So you're taking advantage of all of this ingenuity, innovation, efficiency that's being created in those companies as an owner of those businesses.
That's good. You mentioned earlier, Nick, about somebody selling their company, especially in the pest control world. You've seen some of those happen. Mm-hmm. What do you do after you sell the company? Now, you're used to going to work every Monday morning and, being a go-getter.
Yeah.
Do you go get fat and fish all day, or what do you do for your career? What do you do for your money to grow?
Man, I've heard some of the business owners, they say, the toughest decisions I want after selling my business are like, should I have tequila or vodka when it comes to their evening cocktail. I do think that emotional component, though, is big, okay? You think about these entrepreneurs, right? A lot of them started their business when they were really young. Mm-hmm. It's all they've known, okay? You've built this 50-person company, 100-person company, 200-person company. And as the founder, owner, entrepreneur, you are the center of that universe, of all of these people's lives, right? Who you consider your friends. And then after you sell your business, like, effectively, it's all gone. Mm-hmm. Like, sadly, a lot of folks that were your team members and building that organization that you thought were your friends, like, they're not really picking up the phone anymore and calling you. And so now you do have this void. A lot of those folks, like, some of them are older, some of them have strong hobbies, they'll go into that. But then others, they will make some really bad decisions about thinking that because they built this lawn care business really successfully, that now they can just go start another type of business and it's going to go great. And oftentimes it doesn't, right? Mm-hmm. So you have that overconfidence bias at work just because you built one successful business. So the advice that I always give folks is to just go slow, right? You don't have to go out and start a business, right? You likely have a non-compete, almost certainly have a non-compete. You're not going to be able to start another lawn care business in your area, but maybe there's another home service business adjacent to lawn care that you do know a lot about that makes sense to start. Maybe there are some former team members or existing team members that you had that you can actually invest in them. Like, you're comfortable with their competence. You worked with them for a number of years. You can make an investment to get them started on their entrepreneurial journey. So, and I've seen all of those things, but it's definitely, there's definitely a wide spectrum of activities, and unfortunately it doesn't always go well. It really doesn't. Because there is a void after someone sells a business, right? Mm-hmm. And I then think that mentality, the same way that I couldn't operate a lawn business today, like investing that type of money in broad financial markets, either public or private, and generating that cash flow, that's a foreign world for a lawn business owner. And so, it needs to be handled with extreme care, given the dollar amounts.
Yeah, so good. Well, is there anything we're leaving out here, Nick, that you want to address? I know you got your ears and eyes and life in the money and investment world. What am I missing?
Man, I hate to go there even, but we do have a big election over the next month.
Really?
Yeah, a couple elections. And so, typically, I do think elections can be overblown when it comes to financial market performance. Again, the concept being that markets are always anticipating and have expectations about outcomes of large events. And then also, if you have a divided presidency, House, and Senate, a lot of things can't get done. So the status quo sort of persists. I tend to think, though, in this situation, given small business confidence, that if former President Trump wins the election, I do think you're going to have a reinvigoration of animal spirits among small business owners. Okay, and that can be incredibly favorable for the economy. It can be great for our folks here at John Deere, right? Like, people are feeling more confident about the future. Business owners, they're feeling more confident about the potential tax regime and tax rates that are likely to persist in the future. And so they go out and they buy some John Deere equipment, right? Because they're feeling good about the future. So that could have a big impact, although, things seem to be more going in former President Trump's direction in terms of the betting odds, but it's still a really tight race. And there's tight races in the House as well and Senate. So we'll see what happens with the election. But I do think sentiment could become more favorable for business owners.
Yeah, that makes a lot of sense. And it's painful when I have those meetings with my tax preparer and it's like, here's how much money you make. And I'm like, man, that's a lot. It is painful.
No, it is. And that's why a big focus of my firm is taxes, right? And it's just save money taxes while you're operating your business, save taxes through the sale, and then even deploying taxes that can reduce ordinary income after the sale, right? Because there's a number of strategies. I had a recent really interesting case in that there's a $20 million portfolio, and the portfolio that was constructed was generating about $1.4 million of income from those investments, right? It's amazing, right? That's a nice stream of cash flow after selling your business, okay? And that's because of some of these favorable income strategies that we have, and because the Fed funds rate's almost 5% right now. But after tax, that 1.4 becomes like 950, okay? And so business owners aren't used to paying hundreds and hundreds of thousands of dollars of taxes because they have so many tools through their business to reduce that tax burden. And so through taking $5 million, actually it's about $4 million from that $20 million, and deploying it into investment strategies that seek to produce market-beating returns but create tax efficiencies to reduce that ordinary income tax, we were able to actually turn that after-tax income from $950 to almost $1.3 million.
Wow.
Okay, just from taking four of the $20 million and diverting it to these other strategies that, again, generate a return, but also create a lot of tax efficiencies. So, again, before sale, during the sale, and after the sale, there are ways to mitigate taxes. So,
very well said. How long are you in Louisville for?
I'm taking off tomorrow.
What time?
I'm in and out 2 nights. I'm coming tomorrow to your guys'
morning show.
The morning show. Yeah.
You're not on the West Coast time zone. You'll be able to make it up on time.
I'll be able to make it.
JP comes on at 8 a.m.
Okay, cool. Yeah. No, I'll be there. I want to see that. Yeah.
Cool,
You guys have the whole crew up there. It looks like.
Yeah. What time are you flying out tomorrow?
I think my flight is around noon. 12:30 maybe. Why? What's up? What am I missing?
Well, there's Pod Row. I was going to say you should go do the circuit in Pod Row. There's 5 of my friends who have podcasts are set up.
What time is that happening?
It's going on right now.
Okay.
It's all down in the West Wing. There's one of the podcasters. His name's John Pajak.
Okay.
His podcast is called Profits with Pajak.
Oh, nice.
You guys would go bananas.
I have to go find him.
Profits with Pajak. If you go to the West Wing and you look for Profits with Pajak, he's a big numbers guy. You would have fun. I saw JP lurking in the background, so we're gonna get your friend Jonathan on the program. Nick, I know you posted.
We got to get that guy. Yeah, we have to get that guy in here. Jonathan and I, we're cooking up a whole new show Yeah.
Let's go.
Yeah, it's going to be Jonathan, it's going to be myself, and then it's going to be Paul Gianamore of Potomac M&A,
Yeah.
who's done the most home service M&A volume of anybody.
Wow.
And it's called Routes to Riches. Okay?
Let's go.
Yeah, so really it's all about I call Jonathan the professor because he is like the home service lawn business professor when it comes, when it comes to tactics and everything around, operating a really profitable, successful, growing lawn care business. So the three of us are really going to be collaborating. On occasion, we'll have guests, but we're really trying to take the content up a notch to really help folks create wealth in the home service business space.
I really enjoy your friend Paul. I've watched a couple of your guys' interviews, and they're full of value, very helpful to our industry. So, all right.
And it's about, and the last thing I'll say, it's about advocating for the home service business owner, right? Whether it's through growing, becoming more profitable, reducing taxes, or especially advocating for an owner in a business sale, because you're going up against private equity, you're going up against big strategics, and what they do is they acquire businesses for a living, and you're selling your business once, okay? And so that's where Potomac and Paul Gianamore really come into play.
Yeah.
And we're going to focus on these things on that podcast.
And JP's got the experience of selling a business.
Oh,
so it's like his opinion on selling a business. I want to listen to someone who sold a business, not some professor. So that's going to be a dynamite show. Thanks again to our friends at John Deere for building me this amazing studio here. Thanks to Nick for flying all the way out here. I was trying to recruit him, and I was like, he's not coming, because I told him like 3 times. I'm like, you should come,
Yeah.
and you came.
I went back and forth, but I'm here, and I appreciate the invite. It was awesome to sit down.
And we're going to send you all these raw files so you can slice them. You wore a nice black shirt, so you'll look fresh on the camera and all of that. But and Nick Bartolo on Instagram, and you're on LinkedIn as well.
That's right. Yeah, Facebook, LinkedIn, my first Facebook account. So we got that up and running.
Well, I appreciate you coming all the way out here, Nick. This has been very helpful. Have you learned a little bit today? Elijah, have you learned? So,
Mr. Producer.
Yeah, Mr. Producer. So we appreciate you coming, Nick. Give him a follow, and if you want to reach out to Essential Partners, if you're thinking about selling your lawn care business, his information is in the show notes. And if someone's got a whole bunch of money, $1 million or so sitting around, they can reach out to you.
Yeah, absolutely.
And he'll get you set up. All right, well, thank you guys. I got to go use the restroom real quick before we get JP on here. We're on marathon. This is episode number 5 of 14. Lots of fun. Thank you, Nick.
Great. All right, Paul.